Let me know where you are and let me know your background in swing trading. Okay, looks like everything's good here. All right, Chris. I did do my push-ups today, so I wrote a post a while back about building on push-ups, one push-up at a time, much like we do with our trading here. So a little inside joke there. Oh, wow, a lot of places here. James from South Florida, Dan from Rio Vista, Zorito from Argentina. All right. We've got New York here with Justin, uh, Kevin here from the boot camp. Another Florida here, that's Scott. Minneapolis, all right, Tim. I went to law school at University of Minnesota, so I know Minneapolis very well. I was there for 15 years. UK, my wife's from the UK. Las Vegas, Norway, wow. Another San Diego, all right, Rahul. Houston, Long Beach, good, we're well represented here. Canada, another Minneapolis, all right. Orlando, Florida, Virginia, Baltimore, Spain, that's me. Miguel, another Florida. Why is it there's so many traders in Florida? Is it the state tax, lack of a state tax? Is that what it is? But it seems like we've got more people from Florida than anywhere else. Or are you guys just a bunch of Canals buddies here? Uh, okay, Sebastopol, California, a California city I haven't heard of, but that's Gabriel. I know Gabriel. Okay, Toronto, Atlanta. Okay, Tyler just made it. All right, glad you could get in. Someone's beach trading here. I didn't say where from. All right, Nick, that's awesome. Las Vegas, Nevada, Long Island. All right, so we'll give it a couple of more minutes here. We're going to talk about biotech, and it's something that in the trade report, it's not something that we do a lot of, but when the time is right, I start trading them. And the time is getting to be right now. And part of what we do as traders is understand when to adapt, what sectors to play. And now biotech's starting to wake up a little bit. So it's getting interesting here. So I thought it was a good time to talk about biotech specifically. We'll give it a couple of more minutes here to make sure everyone gets in here. All right, Michigan. Where else we got? Someone, Miami. Okay, all right, and the last few times here I've given some book recommendations because I always get questions about books, and usually it's about trading books. And as most of you guys who have heard me before know, I'm not a big fan of trading books. I think a lot of it is a waste of your time. You learn this stuff by doing, and what's in the books. Some of it might be decent, but really you can never really teach anybody actually how to trade or the trade management aspect of trading, which is really the most important part of trading through a book. So my book recommendations are always in some way, you wouldn't think it's about trading, but I can relate it. So the one I've talked to you guys before is Obstacle is a Way, and I know many of you have loved that book. The one I'm going to show you guys today is Drive. And it's called Drive, The Surprising Truth About What Motivates Us. It was recommended by one of my friends who I respect a lot. But when I saw that part about the surprising truth about what motivates us, I thought it was another self-help book. So it took me a while to actually get to it. But what I loved about it is it talks about our inner motivations with what we're doing, and it relates it to mastery. And I always talk about in trading, you need to master what you're doing. You have to understand it at an in-depth level. And what they talked about was intrinsic versus extrinsic rewards. So let's relate it to trading. So when you're a trader, and you've probably heard a lot of people who make these mental mistakes in trading, they're usually related to fear and greed, FOMO, and what this all relates to is extrinsic motivation. So basically you're looking at the reward, your P&L. And a lot of you guys know if you sit there and stare at your P&L, that's going to really mess you up as a trader. So you can't be looking at the reward. You have to be looking at this from an intrinsic level. Why are you trading? Is it just for the profit? I know ultimately it is. It is about making money. If you're going to trade, if you trade for 2 years and you don't make any money, you're probably not going to continue to trade. But there has to be something at a deeper level, and this book goes into that. So it's a fantastic book. It's a quick read. So if you guys are looking for something to read, go ahead and check that out. Okay, we're about 5 minutes in here, so let's start talking about biotech. First, well, let's talk a little bit about me. I know most of you, I recognize a lot of names here, but some of you might be new. I run the swing trading service at Bulls on Wall Street. So if you go to swing trade alerts here, and this might happen a few times, guys, I've got a nasty virus here, and I get all these pop-ups, so I'm going to have to reinstall my OS here. But anyway, I run the swing trading service here. You get trade alerts. You can see how we're doing this year. We actually just last week hit 50% on the year, so doing really good. And if you notice here, I didn't trade. My trading was focused on commodities and the indexes and some earnings breakout plays the first part of the year, and that's part of our sector analysis. We did trade GWPH, which could be related to biotech and marijuana stock, and the biotech ETF once, which was actually a loss here. But more recently, post-Brexit, biotech has started to wake up here and has actually been leading the market after that kind of topping formation in 2015. So June, July here, AMBA, LABU, EXAS, all biotech stocks here, and I'm putting more of them on our watch list. Some nice wins here, and I'm going to be looking to trade biotech more. I actually almost pulled the trigger on the LABU ETF on Friday and decided to wait. So it's a sector you probably want to be paying attention to at this point. But going back here, yeah, I run the swing trade service, and if you want to know a little bit more about me, go ahead and listen to the Chat with Traders interview. I mentored Kunal, and he asked me to come aboard and run the swing trade service here. You can go into the blog. I have a ton of free blog posts on the different trades we've taken. All right, and then you guys saw the stats here. Now let's talk about biotech. And before we really get into it here, let's talk about some of the hesitations that a lot of people have trading biotechs. I don't know, some of you guys here might be a little hesitant to trade biotechs, and some of you, I see the opposite. All you want to trade is biotechs because they can be volatile, they can be fun to trade. So the way we're trading biotechs here is to fit our swing trading style. So what we're going to talk about in this webinar is not what some of the guys who specialize in biotechs do. So we're not trading off trials, results, and news, and that type of thing. So we're not going to be talking about that today. I do some of that with more of my aggressive strategies, but you really need to be an advanced trader to do that kind of stuff. Here we're going to talk about how it fits our swing trading style and the different ways you can trade some of these biotech stocks and some of the adjustments you have to make. And I think part of the fear in trading biotechs is, one, you hear all the horror stories. Everybody knows about EBIO, the guy who used his entire account to short a $2 stock, and then it gapped up to 20, and he went from a $30,000 account to being down about 200,000. So you hear the horror stories like that, and that's really stupidity on that guy's part. You're not going to make a mistake like that. So you really need to understand how biotechs move, the different types of biotech stocks. So, you know, a while back, someone actually asked me, this was a couple of years ago, so what is biotech? And, you know, you say it all the time, but when I tried to really pin down what it is and what types of stocks it is, I realized that biotech is kind of a catch name that incorporates a lot of different types of stocks, a lot of different types of companies. So you have what we think of as pure biotech stocks. Then you have the big pharma stocks. You have the low floats, the mid caps, the bigger type of stocks. And then you have other things related to biotechs that actually make the biotech ETF stocks. So the biotech ETFs have medical devices. They have pharma. They have healthcare companies sometimes. They have this straightforward biotech company. So it really is a big basket of different types of stocks and companies. And when you're trading a quote-unquote biotech stock, you need to understand what type of company it is. And part of these fears is not understanding really what we're doing. So you want to have an understanding of what biotech is, the different types of ETFs you can play with biotech. And I was actually surprised that so many people trade these biotech ETFs and have no idea what they actually are a basket of. The difference between IBB and XBI, which we're going to go over in a second here. And you definitely need to know if you're trading a large cap, mid cap, or small cap biotech, and your strategies are very different for each of these types of stocks. So we have specific strategies to trade and different adjustments. Actually, the strategies aren't that different. It's the adjustments in your trade management and the style of trading you're using. You need to have a process and routine. You've got to be doing the same thing over and over. So when you're trading a small cap, low float biotech stock, you got to be looking for these specific things and always trade it that way. And when you have these processes and routines, it makes you feel like, and you will know what you're doing, and that will overcome some of the fear. You need, this is a must, out of all these things, to protect yourself, you must decrease your risk. So with biotechs, I'm always trading them smaller because they can be more volatile, and that can be good and bad. It can be more volatile to the upside, but it can be more volatile to the downside as well. So you need to decrease your risk. So if your normal risk on a trade is 1%, you're normally going to trade 0.5%. That's what I've done in the trades this year in the trade report. I've been trading them a little smaller because I know how volatile they can be. And then finally, for what we're doing here now with the swing trading for part-time traders and more of the standard swing trading strategies, we're not really adjusting too much of what we do for biotech. So don't trade the highly speculative stocks, the really cheap stocks. And we trade low floats, but then there's those extremely low floats. We're not going to touch those type of stocks. So, you know, the $2 EBIO, we wouldn't be trading that as an overnight hold. You can trade it as a day trade. I don't have a problem trading those type of stocks, but for this type of swing trading strategy, we're not going to trade those types of stocks, and that's really where most of the horror stories come from, is those types of stocks. So there's no need to have any fear in trading these types of stocks here. And again, we're focused on a more conservative swing trading approach, and conservative doesn't mean it's boring. It doesn't mean you can't make huge profits. We're up 50% on the year. I'm talking about the hyper-aggressive types of trading. We're not focusing on that here today. Okay, all right. And looks like I've got some of those issues here again with that malware or virus, and there we go. If anybody knows how to fix this, let me know so I don't have to reinstall my OS here. Okay, let's talk about trading the biotech ETFs. This is the safest approach to take. It's a basket of stocks, so you don't have to worry about one stock gapping up or down. But these ETFs still do tend to be more volatile than other types of sectors and ETFs. So you still need to be a little bit more careful. Now, there's three major differences between the main ETFs we look at. And essentially the way I look at these is when we think of SPY, the Qs, and IWM. So SPY is going to take some of the bigger stocks, Qs, you know, the top 500 stocks that usually made up of the bigger float stocks. The Qs are going to be some of that, but also some of the mid caps. So you're getting a little more volatile with the Qs. And then you have the Russell IWM, which is going to have more of the small cap, the low float type stocks. And that tends to be the more volatile sector. It's the same thing for these three major underlying ETFs. So when I'm analyzing the tech sector, I'm looking at IBB, FBT, and XBI. And it's good to know FBT, but we really don't trade it that much because there isn't a good vehicle to trade it. I'm not trading these underlying ETFs. I just use it for my analysis because they're not volatile enough for me. So I use the leveraged ETFs, and we'll talk about that in a second. So essentially when we're looking at these, we can think of IBB relating to SPY, so the bigger caps. FBT relating to the Qs, so more of the mid caps thrown in, and then XBI is going to encompass more of the small caps, which is nice. It's a way to let you play the more aggressive small cap type stocks and not have to worry so much about the crazy things that can happen with an individual biotech company. So it's a really good option for some of the more aggressive strategies to use XBI. Now, IBB, because it relates to SPY and is the bigger companies, is the least volatile, the most boring. It actually moves for the most part, unless biotech is just full. It tends to move like many of the other sectors. So not that much volatility here. So the TC 2000, so I use telechart here, and on my telechart, if you look at these numbers here, this is short interest, this is price volatility. The volatility of IBB is 23. That's a pretty low number, so not that volatile here. Now, it's heavily weighted in some of the safer, I spelled safer wrong, some of the safer big cap stocks. So think the Amgens, the GILD, PFE, the really big cap stocks. So I think AMGN is around 500 million, PFE, Pfizer is I think 2 billion. The top 5 holdings in IBB make up 40% of the ETF. So most of the move is going to come from these bigger stocks that aren't very volatile. So if we look at the volatility here, I've got these are the stocks that make up that ETF. You can see GILD is a 1.4 billion float, which is very high. We consider low float under 100 million. Celgene, 772. Amgen, 651. MYL, 434. So these bigger companies right here make up almost half the ETF. And bigger companies tend to move a lot slower. So I have these organized or rated here by the float size, and you can see here price volatility only 25. And as we scroll down to these lower floats, all of a sudden you're seeing higher numbers on the volatility, 64, 45, 75. So these are the type of stocks we're going to want to trade, but they don't make up a big percentage of IBB. So that's something you should be aware of when you're trading it. It's not quite as volatile. So you can tend to use the normal strategies you always use, the safer technical type strategies. And thanks, guys, for the tips here on I can use to get rid of the that pop-up I'm getting. Okay, so heavily weighted, and think of it as SPY. Now, FBT, I actually don't trade this, but I use it for my analysis. But there's not a good vehicle to trade it. But this would be more of the mid cap. So think the Nasdaq. Now look at the number here. IBB is 23, and if we look at SPY here, its number, oh, not SPY, FBT, it goes from 23 to 26. Not a huge difference here, but a little more volatile here. So it's the middle ground, has some more mid caps. Price volatility is at 26. Now, my favorite, XBI, because that has more of the small caps, and it allows me a way to trade the small caps safely. It's the most volatile. Let's take a look at that price volatility number. 23 for IBB, and XBI is 34. So that's a significant difference. You're going to get more volatility, potential to make more money off this ETF. And wait till you see the leverage ETFs. Then you're going to see a really big difference in the volatility and the potential for gain and loss when you're trading it. So XBI tends to be the most volatile. It has more early stage speculative biotech. So if I was to pull up XBI here, which I actually do have up here now, you can see Amgen. It does have a few of the bigger ones. Guild is a part of it, but they're not as heavily weighted, even if they are in there. And it's more weighted towards these mid-cap and lower float, I shouldn't use the word cap, float stocks. And you can see the volatility, how high the volatility is on some of these. On SRPT here, we have a 113. And that's, as a swing trader, we want these volatile stocks where we can capture a lot of money in a short amount of time. So that's the reason we like to focus on XBI. So more early stage speculative biotechs. The top 5 holdings like Celgene and Amgen, although it does hold them, the top 5 holdings only make 15% of that. Make up 15% of that ETF. So you can see here where IBB is heavily weighted in those. XBI is not. So you're getting more influenced by the mid and smaller caps. There's more pure biotech plays versus IBB, which has medical devices, has some of the bigger pharma companies. So when you think the type of biotech stocks we generally tend to think about, they're going to be weighted for XBI. So compare that to IWM, the Russell, versus SPY. Okay, so now you know the differences here. So, and essentially we're going to be trading IBB and XBI. So we know we can use standard strategies with IBB. We can use, we need to use some different types of strategies with XBI. So now let's talk about the trading vehicles. And actually, before we do that, what I did was I did a comparison here between IBB, FTB, and XBI. And look at the difference here. So mid-February was when we got the bottom from the big biotech pullback from 2015. And that's when we started to bottom. And look at how this has played out since. The green is XBI. XBI is up 40% since that time. While IBB, and we'll ignore FTB for now, but IBB is up only about 20% during that same period. So because XBI is more volatile, has more of those smaller stocks that can move, it's crushing IBB right now. Now at the same time, you can have bigger downswings between these. You can see, just eyeballing it here, a lot more volatility with XBI than IBB. So you have to be aware of that, and we'll implement some strategies to counter some of that volatility. Okay, now the trading vehicles we're actually going to use. Our analysis is going to come from IBB and XBI. But the vehicles we're actually going to trade, IBB, we're going to trade BIB. For XBI, we're going to trade LABU. So LABU is the underlying, would relate to XBI. IBB would be BIB. So let's talk about BIB. It's double leveraged. So in a perfect kind of theoretical world here, if IBB is up 2%, then BIB will be up 4%. It doesn't always play out exactly like that, but it's pretty close. So we would expect here, with this chart here, if IBB is up 20%, we would expect BIB to be up around 40% during that period. Okay. It's safer because of that. It's a little less volatile. So if the triple leveraged nature of LABU, and you can get some wild swings in LABU. So if that's a little too volatile for you, yet BIB is not volatile enough, BIB is a happy medium here. And it tends to trade more technically correct. And when I say technically correct, it trades more in line with the standard setups we like to trade as swing traders. And it doesn't violate a lot of the kind of technical patterns we look at. So that's always nice that we can make these standard kind of plays with BIB. Whereas with LABU, we have to be a little more adept with what we're doing. So it takes a little more seasoning to trade LABU effectively than it does BIB. But BIB is a great option if you're looking for that extra volatility to trade the biotechs. Now LABU, remember LABU is trading with XBI. So on its own, even if it wasn't triple leveraged, it already is more volatile than IBB is. Now on top of that, we're taking XBI and we're triple leveraging it. So you get some extreme volatility here. 40% during that period, LABU could be up 120 to 140%. But at the same time, it's more volatile, and you can get some downswings with this. That's okay. We don't mind that because as professional swing traders here, we know how to manage our risk. That's the whole idea behind this. We know how to maximize our upside, and we know how to limit our downside. So if we're good traders, that volatility is a positive, not a negative. So where we talked about BIB being more technically correct, with LABU, we have to do more risk analysis and think about the trades less in terms of setup and more in terms about good reward to risk and the type of risk we're getting, where at times you might not even see a real pattern, but if you've got a good reward to risk, you can go ahead and take the trade because you know that volatility could be in your favor. And we also focus a lot on relative strength. Relative strength compared to the rest of biotech, so XBI versus IBB, and relative strength to the market. So the trade I pointed out here that we took with LABU post-Brexit, early July here, there really wasn't a technical pattern I was looking to trade there. What I was doing with that, and that seems a little backwards to some of you I know who are just focused on setups and scans and patterns. But here, I didn't really care about the pattern. What I cared about was small cap biotech was showing a lot of relative strength compared to the market coming out of Brexit when we had that big drop back in late June, early July. So it was basically a risk play and a relative strength play, more than any technical pattern we were seeing. So let me just pull up LABU for you guys, and you can see what I'm talking about here. This was the sell-off Brexit, which it actually handled better than SPY did. And when it made its move to its upside, it got back over its initial pre-Brexit move area much faster than SPY did. And really, that's all I cared about, and it got over its key levels, and we could pull up XBI and we'd see the same thing. So there was really no technical pattern here, aside from maybe some remounts of moving averages. But that's what we were basing it on. And I do a lot of that type of analysis with LABU versus looking at any technical patterns, although we do have kind of a nice bottoming, recent bottoming formation and maybe a cup and handle remount of the 200 here on LABU right now. So it is forming this kind of technical pattern currently at this moment, which is why I almost took it yesterday here. Okay, now this is a key adjustment we have to make when trading LABU. If you don't use loose stops when you're trading LABU because of that extra volatility, you're probably going to continually be stopped out of really good positions. So what you'll find a lot of times, and those of you, let me know if this has happened to you when trading LABU, you can throw it in the chat here, but if you've been in LABU and you love the setup, but it just pulls back farther than you could hold according to your risk, and then right after you get stopped out, it flies in the direction your analysis was telling you it was going to go. And if you don't use a loose stop, you're going to get crushed because of that extra volatility. So, you know, if XBI is moving 1.5%, LABU is going to move 4 or 5%, and you're going to get stopped out right away, where you'd probably, if you were just in XBI, you'd be able to hold through it. So it is a must with a lot of biotech. Same thing with when we go to the low float biotechs. But with LABU, because of that extra volatility, it's a must that you use looser stops. And what does that usually mean when you're using a looser stop? It means that you're adding risk if you keep that same position size. So you need to trade smaller. But that's okay, because this thing is so volatile that even if you trade a little smaller, you can still get those outsized gains. So key adjustment, looser stops, smaller position size, or smaller risk, not necessarily position size, but risk is smaller. So for example, my standard position sizing, depending on the market, what I'm seeing, is somewhere between 0.5 and 2%. So when I'm trading a $100,000 account, the most I'm ever going to risk is $2,000. The least is probably going to be around $500. When I'm trading LABU, the risk is going to be towards that 1%. I'm usually not going to go, unless I really love it, I'm not going to go to that 2% because I need to be able to use these looser stops. Okay, another key adjustment here is because it's so volatile and it's day traded a lot, we can get some wild swings, much wilder than XBI or IBB, and sometimes it has a little bit of a mind of its own, because although they track indexes, they also trade on their own supply and demand. So they can move a little differently than the underlyings. And you might see some really quick intraday moves that can shake you out or give you false signals. So you need to focus. What I do when I'm trading LABU is I watch the open and the close very closely. And I'm usually making my decisions on LABU near the close. So I want to have that confirmation that it wasn't just some intraday action. It's a strong move and signal, and you'll get that at the close. So those are really the key adjustments we're making to trading the ETF here, the triple leveraged LABU ETF. Looser stops, smaller position sizing, and focus on the close. Again, we use the underlying for our overall analysis. So I'm going to look at XBI, and then I'm not even going to watch LABU until I find that XBI is doing what I want it to do. Then when I get interested in XBI, I'm going to drill down to LABU and actually look for my signals. Okay, at this point, are there any questions? We'll give it a minute here. If you have any questions, we can go ahead and answer them. All right, looks like you guys are pretty good here. Okay, let's talk about, actually, let's look at the difference between LABU and BIB here. Okay, I've got one question here. Never understood the idea of a stop. Okay, that's not specific to biotech, but essentially, when you buy a stock, you're risking you want to risk a certain amount. You're not going to hold it. If you've got a $100,000 account, you're not going to let it go down to $50,000 on one trade. There comes a point where you have to get out of the trade. I generally will never risk more than 2%. So my loss on a trade on that size account would not be more than $2,000. Okay, how loose are we talking about when we're talking about stops? You know, there's no hard and fast rule here. What I do is I will take into account the price action and the volatility of the stock and base it on that and see if I can fit whatever risk model I'm using. So if I've decided it's going to be 1%, I'm going to look at, let's say we took LABU right now on this break of the 200-day. We've got a remount here, really strong trend move. We got the pullback, some consolidation, and it looks like we might have a break and the next move might be coming. So where am I going to place my stop if I enter today? Definitely would be below the 200 moving average, and it becomes a little tricky because we have to pay attention to the underlying also, and we've got a lot of room for the underlying here. But we do want to stay above the 9, or we do want to stop to hold through the 9 on the underlying. For momentum stocks, the 9 EMA is a key level. So I would say I would be looking at the underlying here, and I would assess the previous candle here, which was right in here, and that if I place a stop under that, that would give me a good stop placement. And for here, I would to be able to do that. So I need that loose stop here. Whereas on XBI, it's no big deal. It's pretty tight because of the volatility in LABU. Instead of being about 3 or 4, whatever percent that is, 8%, or 2 or 3, it's like 8% here. So I've got to have my stop all the way down here at 41 on a 44.80 entry. So it's got to be a pretty loose stop here. And because of that, I'm probably going to have to position size a little smaller, but that's okay because I know if this thing runs, it can move much faster than XBI would. Okay. All right, here's a comparison here between LABU and BIB. So you can see here, this is about the same range here, mid-February, that we looked at the underlying comparison. And look at IBB was at about 20%, XBI was at about 40%. Now let's look at what the leveraged ETFs have done. BIB during that period, pretty close to 2 to 1 at 35%. And then look at LABU, all the way to 110%. So you can see the type of gains we can get trading LABU versus trading BIB. It's not even close here, 35% to 110%. and then the underlyings 20% to 40%. And look at this here. The XBI itself, just the underlying, is up 40%, whereas the leveraged ETF for IBB is trailing XBI. So that's why we like to focus on these smaller cap type ETFs. Gives you the best of both worlds. You have the safety of an ETF, but you get a little bit of the volatility of trading more of the speculative type stocks. That's why, if I had a choice, if I had advice to give anybody, it would be trade LABU versus trading the individual stocks. But we will still go over trading the individual stocks, and I do trade them. But we can see here 110% versus 35, and the other thing you will notice is the volatility here. Even though this is up 110%, it's had some wild swings here. So this is why we need those loose stops here. This has a range of 5% here to 110, so 105% range here versus BIB, which is in that, say, down. It was at one point down about 10% versus about a 45% range here. So much easier to trade BIB, but you can get the outsized gains trading LABU. Okay, any questions? We're going to move on to individual stocks, but really quick, again, if you guys have any more questions here, let me know. Do you play the downtrend in LABU? Great question, Milan. And I get that a lot, because what I normally do is, if I'm going to short LABU, I mean, we've been talking about this stuff from the long side, but there are opportunities to short also, especially when these sectors get very extended or when they're in downtrends. And we can see LABU, but the entire biotech sector from mid-2015 has been in a massive downtrend. Now, what I like to do, you can trade the inverse ETF, which is LABD. I don't like the way these inverse ETFs move, and you can see here the gains would be much better if you just traded LABU the way you want to trade it. Plus, from your mindset, you're analyzing it, looking at it like this, so it can be difficult to flip it around. So rather than trading LABD and just going long at LABD when I want to short, I just short this ETF directly. So if I see the short set up in LABU, I'll just short it. Some of the retail brokers, that's tough to do. So if you've got Ameritrade, Fidelity, I've had people tell me that they have problems shorting it. Much better in interactive brokers, and then I'm sure some of the more direct access and the ClickFund, Canal's ClickFund. Much easier to short, but there are times when even in interactive brokers, they won't have shares available to short something like LABU, and then I'll have to switch to the inverse. But if I can, I prefer just shorting LABU directly than flipping it over with LABD. Okay, all right. Let's move on to the stocks. Now, it's really important here to know the difference between the type of stocks you're trading. Really quickly here, someone said they lost the connection. Are you guys hearing me and seeing me okay? Just type it in the chat here. Looks like it's all good. Great. Okay. It's really important to know, now we're moving on from ETFs. Now we're going to talk about the stocks, and a lot of the same concepts apply. So the big boys are the guys that weight IBB. The low floats are those smaller float stocks that we're talking about, the small caps and the mid caps. So the big boys, think AMGN, Celgene, Pfizer, these types of stocks. Now when you're trading these tend to be less volatile, and we'll pull up the volatility numbers here, and you'll see what we're talking about. AMGN, 27, that's a very slow stock. Celgene, 31, a pretty slow stock. Pfizer, 20, really slow. So you don't really have to make any adjustments here. You can essentially trade these just like you would trade an Apple, which is not a fast-moving stock anymore either. But the way you trade most stocks is the way you can trade these stocks. So no adjustment really needed. Use the standard swing trading style that you would normally use. So really not a lot to talk about there. Now let's talk about the low floats. I don't know why I put AMBA here. I think I was going to make a list of some low floats, but think of the stocks like AMBA, or what you think of when you think about a little more speculative biotech stocks. So the stocks that are in here under 100 million, and there's a lot of them. So that's the type of stock we're talking about here. And this is often where the bad traders get crushed, and it has nothing to do with some of the horror stories with biotech. So it doesn't have anything to do with buyouts and trials or anything like that. Traders get crushed on this just because of the added volatility, and they don't understand how to trade that volatility. So again, much of what we're doing with LABU, we're going to apply to these lower float stocks. And when we're talking about lower floats, we're talking about under 100 million on the float. 150, we could consider that a low float. And anything above that, we're talking more the bigger type stocks that are going to move slower, and we don't need to have to make that adjustment. But around 100 million or a little above that, we're going to start making adjustments. They tend to be more volatile momentum type stocks. Now, the key adjustments, we've already talked about this with LABU. You're going to decrease your position size, but we're going to decrease it even more than we would with LABU, because LABU, we have the protection of having a basket of stocks. We don't have that protection with trading in individual stocks. So we're going to get even smaller on this. So where I talked about 1%, 1.5% on the risk for LABU, for one of these lower float stocks, I'm probably not going to go over about 0.7, 0.8% on the risk. So if you've got a $100,000 account, you probably don't want to be risking more than $700 or $800. And you'll be surprised, because sometimes that $700, $800 risk that you go in with, if there's a gap down, that's going to turn into a $2,000 loss. So you have to protect yourself knowing that that can happen. So if you, instead of the $700, if your plan going in, instead of 700, was to go on your higher side of your risk parameters, which would be 2%, and that same thing happens, instead of being down $2,000, now you're going to be down $6,000. And that's the type of thing that can crush your account, especially if you have 3, 4, 5 of these trades in a row. And that's where people get crushed trading these low floats, biotechs. It usually has nothing to do with some of these crazy things you hear about. It's just not protecting yourself and understanding how to manage these trades and understanding the risk behind these trades. So smaller position size, again, you want to give yourself a looser stop. I'll use AMBA as our example here, since I traded it recently. I don't remember exactly where I entered it. Let's see here. That one was on 616 to 727, and you can see I only took 400 shares of this, trading it really small, but I was still able to get a decent gain because these things can be so volatile. So let's look at AMBA 616. Okay, I have the arrow right here. Okay, so this is where I entered. Now, through this here, there was plenty of volatility, and you can see the volatility measure here is 55. So remember when we were looking at IB, that was 20. So this is, and even XBI was 33, and we're at 55 here. So a lot of trade report members did not participate in the move that we traded here through July. So I think we got out around here for a really nice gain in here. But you have to be able to place it through some of these dips here. And this one actually didn't even dip a lot, but still a lot of trade report members had trouble holding through this and didn't capture the big gain in here. So you have to be able to loosen your stops, and that would be the trailing stop that you'd be loosening. But essentially what we're talking about here, you have to allow for volatility. Otherwise, you're never going to get the big wins. You're continually going to be stopped out. Now, and this applies to LABU. You know, we've talked about protecting ourselves, but the great thing here, because it's more volatile, you can be more aggressive with your targets because these things have a lot of upside. They're more volatile. So where we're normally talking about grinding out trades and getting singles and doubles, here you can go for the triple. and maybe the occasional home run. But you can go for bigger wins here. You don't have to stop at 2-to-1 on this type of trade. So, for instance, going back to AMBA here, a lot of traders, when they got this nice little gain here, and it was a fantastic 2-to-1 or 3-to-1 trade, got out right away. But look at what you missed in here. And even I got out here at around here, at around 57, I think it was. But even I gave up some of this upside here that I probably should have stuck through. So go for the bigger wins on these because they're available. These things, because they're lower float, because they're very volatile, because people love to trade these, they tend to move farther than you think they can. So go for the bigger wins. Be more aggressive. Number 4 here, and you hear me all the time saying, ignore the news, follow the price action. A little different with some of these lower floats. You have to pay attention to the news a little bit. So if there's something that's really, some news comes out that might worry you, I will jump out of the biotech trades. If there's something really positive, I may stick with it longer. You don't have to go parse the news and read. If you just monitor the headlines, that should be enough. But with most stocks, I almost completely ignore the news except for earnings or something really major. But I'll watch the news a little bit closer on some of these low float biotechs. Now, those of you who have followed me for a while, you know how much I talk about sector analysis. 80% of a stock's move is its sector, and we could pull up just about any of the hot sectors. And just for a little exercise, I'll show you guys here. Here's the silver sector. And if you were to pull up, I don't have the sector grouping here, but the SSRI is a stock within that sector, the exact same pattern. We could pull up 10 different silver stocks. They're going to put in the exact same pattern. But now, if we go to the lower float biotechs that make up the biotech sector, we're going to see a lot of different, actually a lot of them are following the same pattern, but generally we're going to see a lot of different patterns, and wow, they are a lot of the same patterns. So this wasn't a good example here, but generally you're going to find some of these lower float biotechs that are going to have kind of a mind of their own and will not always follow the sector. The nice thing about that is in markets that maybe you don't feel like making any trades because you don't like what the sector is doing, you don't like what the market is doing, if the stock itself has its own catalyst, you can find different types of patterns in what the sector is doing. So that can be good and bad. All right, so this is really what we're going to key in on here. I don't trade the big guys very much. I like to trade these low floats. And when I say low floats, I'm talking about maybe 100, I wrote 100 here, but even 150 million and lower, down to about 25 to 30 million, and maybe a little lower. Depending on the stock and its volatility. So there's the big boys, there's the low floats. Now there's another group, and that would be the junk. And generally, and this isn't a hard and fast rule, sometimes there's 15 million floats, which are actually pretty good companies. But generally, oh, okay, thanks. So my example wasn't bad. Thanks, Richard, for pointing this out. The reason this was all looking the same is because it's the silver sector. So this is my what I was talking about here. You see almost every silver stock is putting in the same thing, whereas if we were to pull up biotech here, you're going to see a lot. There we go. Now we're seeing a lot of different types of patterns that aren't necessarily with what the sector is doing. Okay, so my point was correct. All right. Now, this is the area we're going to key in on for our swing trading, is these lower floats, but more safe type stuff. They're still pretty safe type stocks, but still we're going to protect ourselves for the added volatility. Now, the stocks that we're not going to trade for this type of strategy, that doesn't mean I don't trade them. I trade junk stocks all the time, but I'm at the screens every day and I'm monitoring stuff very closely. But the stocks that are generally under 20 million, 15 million, 10 million on the floats, we're probably going to stay away from those. The stocks that are coming off being $1, $2 stocks, Now this is where we talk about traders being crushed because they don't know how to trade. But this is where you can get killed. And where the horror stories come from, unless you really know what you're doing. I'm not saying you can't trade these, you can't become an expert at trading them, but they're not a focus of what we're talking about right now. I know some traders who focus exclusively on biotechs, and this is all they trade, and they're amazing at that. But there's a deeper analysis you have to do, and not just a technical analysis. You actually usually have to know a little bit about the companies and what's going on. So we're not focused on these. If you are trading these unless you really know what you're doing, it essentially becomes gambling, and at some point you're probably going to get crushed here. So our standard swing trading style does not fit the junk stocks here. An example which I actually did trade was, many of you will remember this one from 2014, Lake. This would fit the junk stock type of move, and there is a setup I use for trading these. I think in the trade report at the time I mentioned it, but I would not trade it in my trade report account because it's just too risky for most of you guys to trade. But this is the classic junk stock parabolic short, which I actually do teach in the boot camp and in that new swing class we're going to be starting up on Bulls on Wall Street. But for what we're talking about here, we're not going to be focusing on these type of stocks. And you can see you get these crazy moves, and this was a 6.7 million float. So that's where you can get some of these insane, crazy type moves, but you really have to know what you're doing here to be able to trade that. Okay, any questions here related to trading the stocks? And you know, our focus right now, these are some of the different setups that I use that work really well with biotech. So we have a basket of, say, 20 or 30 different setups. And there's certain setups that work good with certain strategies, with certain markets, and with certain sectors. And we're not going to go into all of these setups here, but these are some of the setups that do work really well trading biotechs. What constitutes a stock being parabolic? It depends. You know, a lot of people throw around the term parabolic. When I'm trading parabolics, I'm looking for a 100% move in a stock, and at some point giving me a short signal. You mentioned the new swing class. When can we expect to hear about it? We're working on it right now. I'm working on some of the content in videos, and I would expect it to be ready in about a month or two. What volatility tool tracker do you use? Number one, I use my eyes. So I use this volatility here as a guide, but in general, I'm more eyeballing stuff. Like, we know this is pretty volatile, and what I like to do is I'll take a look at the underlying ETF. It's moved 20%, and I'll look at the stock that I'm trading and seeing during that time period, what percentage did it move. I like doing that much more than just some measure that's thrown out there. But if you do use TC2000, then I do use this as kind of a guide here. You can add this to your chart by right-clicking here, going to Edit Toolbar, and then add in Price Volatility. That's what they call it. You explained AMBA, but that is a semiconductor company. I've seen it both ways. So in Telechart, they label it as semiconductor, but some of these labels don't really fit. So somehow I would imagine that it relates to biotech, because I have seen it under biotech, and I do think it's within one of the biotech ETFs. But if I'm wrong about that, let me know. But I'm pretty sure it's in one of the biotech ETFs. But regardless, the strategy is the same for that. How often can we look forward to new webinars? I try to do one every month or two. At the beginning of the year, when there was a lot to talk about, we were doing one every 3 or 4 weeks. It's been a little while because I was doing some classes in the boot camp and some other things, but I would imagine we'll do one again next month. Price volatility in FinViz. Ernesto, and I know a few of you others have asked about that. I know there is a way to do it. I can't remember off the top of my head, but experiment in there and you'll find something, don't use ATR because average true range is more of an intraday measure, and we're looking at a trend measure, not intraday movement. Paul, are pharmaceuticals like biotechs have the same volatility? Yeah, and for the most part, especially with these ETFs here, pharmaceutical companies get labeled in with biotech. So we are thinking of it the same way, but the bigger pharmaceutical companies are much slower, so we don't really trade them like we're trading these smaller cap biotechs here. Please put the presentation back up. There you go, Kevin. All right, okay, so let's talk about some of the setups that work. Catalyst breakouts work very well, especially because these are low float stocks. Once you get that catalyst and breakout, they tend to move really well. So low float biotechs, I love to trade them off breakouts. So earnings breakouts, any type of significant news breakouts. The type of breakout that I'm going to be hesitant on is if it has something to do with rumors. So if it's rumors about a buyout or something like that, those type I'll discredit. But if it's a trial that went really well, something fundamental in the company, earnings breakout, a lot of these that we have listed here, these are coming off earnings breakouts, and now the earnings breakout is the catalyst for these low floaters to really move. Parabolic shorts work really well for biotechs because they tend to run much further than they're expected, and they also tend to be heavily shorted. So you get a stock running really high because of a short squeeze off a catalyst, and pretty soon it's going to come right back down. And on an extreme basis with this junk stock like Lake, you can see what happened here. So these parabolic shorts work very well with biotechs. And then reflex bounces. And what I mean by a reflex bounce is, you can see here, we'll continue to use Lake as our example here. You get the big crazy move up. And again, Lake is an extreme example of all this. You get that move down, and then you'll get a little off the parabolic short, you'll get a little reflex bounce that you can play. And it's not really that little, even though it looks like it on the chart here, because we're looking at the previous action. But this bounce here, after the short move, was from 12 to 16. So that's what would that be? That's a 25% move, even though it looks real small here. So these reflex bounces can be really nice to trade off biotechs because we get that volatility. And then off the reflex bounce, so you can see this is a big cycle. You can get a second thrust short. And what I mean by second thrust, you get that first wave down, you get the reflex bounce, and then you get that next wave down. You can see, the reflex bounce was at 12, and then this went all the way down to 8, which is again another 40-50% move, or 25-30% move. So these are the type of setups I like a lot with biotech. And then also, remember when we were trading the ETFs, when we're trading LABU, we talked about this then, it's not always a setup. So if I get good reward to risk, if it's showing relative strength, I'll jump in regardless of one of these setups here. And then always be on the lookout for biotechs that have a catalyst and have high short interest. So biotech stocks tend to be some of the most heavily shorted stocks. A lot of bets against biotech stocks. So we'll go through this here, but you'll see that a lot of these biotechs here that I'm looking at, they're heavily shorted stocks. And sometimes I'll make a list of biotechs where I don't even have a pattern yet. Nothing is going along on with that stock. But I know if there does end up being a catalyst, we could get a huge short squeeze. So I'll just make a short squeeze list of maybe 20 biotechs that are really heavily shorted. I'm not going to touch them yet, but once that catalyst comes in, I know there could be a big squeeze, and I'll just jump in. And again, that's not pattern related, so most of what you're always thinking about is patterns, but you don't need the pattern with these. If you've got a catalyst, you know it's highly shorted, and you've got good reward to risk where you can manage your stop, you can just jump in and trade it without having to have this overall pattern for trading. So very different than the way a lot of people look at it, and I think a lot of people are trading these incorrectly because of that. But there's different strategies you can use that don't necessarily fit some of these classic patterns we're looking at. Okay, so now let's talk about some of these hot biotech stocks right now. All of these stocks are on my watch list, and in the trade report, some of these have been on my focus list. EXEL, AMBA, ARIA, EXAS. EXAS we just actually traded off the earnings breakout here, 1598 to 1701. I actually got spooked here. I should have went for the bigger gain. It's flown, I think, up to 20 by this point. But when I was talking about watching for news that comes out with biotechs, right after earnings, the insiders started selling shares, and that spooked me. And if I get spooked, I'll get out of a biotech very quickly, which I rarely do with other stocks. But the fear was there that they were just taking that big earnings breakout and selling the profit there, but they claimed they were going to reinvest it in the company, and apparently the market thinks so too, because it has flown since then. It reached a peak here of almost 22, and this was our entry on the breakout at right in here at 1598. Low float, under 100 million. Now, some of the short interest has been worked off. So this is my float number. This is the volatility number, and look at that. We were talking about 20, 30, 40, 50. This is 129. Very volatile here. And this is the short interest ratio. It's at 530. This was at a much higher number, and part of this was probably a short squeeze after the earnings breakout. Let's look at a few of the others here. XL, we just went over, or actually that was XAS. Let's go over XL here. Another really good one, another earnings breakout. So a lot of these biotechs had good earnings this quarter. Pretty good short interest here at 8. So I like that because it's got some short interest. Float a little bigger, but it's volatile. It's got 64 on that number. That's pretty good. So actually, I know a few people in the trade report, because I do list my focus lists, and even if I don't trade them, we'll point some of these out. A number of trade report members entered on the hold of the 9 here, and they're doing pretty well, and this thing could start running here really nicely. Good setup there. High short interest. We'll skip AMBA. We already talked about that. ARIA. You can see here another big breakout. Look at the volatility measure, 69, really good. Not huge short interest, but pretty good. I consider 4 okay. 10 is fantastic. Low float, around 150 million, so pretty good. And it's made a nice run here from 8 to 10. Now we're looking for the next setup. I'd probably look to play this either if it broke the high here, or if it tested the 9 and then showed some strength with it, which it kind of already has, and really good volume pattern. All of these that we're looking at here have really good volume patterns. Okay, ARIA, EXAS we talked about. Let's look at SGen. All right, so this one's a little slower. So this is an example of one that might not be setting up right now. Doesn't look fantastic, but there's a reason I have this on my list, and this could become volatile. So maybe we do this one before it actually starts to get really volatile. And even without the huge volatility, it has made a move from, since February, a move here from 26 to almost 50. So it's still about 100% move since then. But what I love about this, look at that short interest ratio. We talked about 5 or 6. This is at almost 20. That's fantastic. If we get a catalyst here, this thing could really run, and it is pretty low float here at 60 million. So this is one I like a lot. If it can break this key kind of round number here at 50, maybe we get a big push to 60. So this one is definitely on my radar here. ALNY, volatile here, a lot of short interest, almost at 10. Has made a nice run here, and now has remounted our 200-day moving average. So this is setting up nicely for the next big push. And look at the upside here. It's got a recent high here of around a 110. So we know there's some room to move here. And then finally CLVS and ALDR. Okay, there we go. What I like about this one, now if we pulled it out here, it doesn't look like much, and it's gapped down here from 100 all the way down to 23. So this is a little more speculative. 30 million on the float, has some good short interest, but look at this catalyst. So I'm going to analyze this very closely. If it can hold this 200-day, I'll look to maybe get in here and play a bigger move. Now also, maybe I don't want to get in here on the long side, but maybe we get a parabolic short at some point if it continues to run and then looks ready to pull back. And then finally, ALDR. This is another one where not quite set up yet, but maybe we can get in on this early if we start to see a catalyst and it's got a ton of short interest and is a low float stock. All right, guys, so that's what I wanted to talk about biotech today. Kind of the way that I look at biotech and the way I trade it. Biotech is coming to the forefront now after this big topping move here, after a big 2, 3, 4 year trend here. And now biotech looks like it might be waking up. So pay attention to LABU, look at IBB and XBI, pay attention to some of these low float type stocks or mid float type stocks. And then if you're looking to a quick way to analyze biotech, all you have to do here, there's a way to do this on FinViz, but on Telechart, if you use Telechart, all you have to do is pull up the ETF and click on this button here, and you have access to all the biotechs that make up the sector, and you can run through these in about a couple of minutes here and find the good patterns. Or the chart, you can go into the industry indexes, the industry indexes here, there we go, and then just pull up the biotech sector and get the stocks that way. So I've got a few minutes here. Let's take a few more questions. And remember, guys, we've got the swing trade alert service. So these statistics you see here are trades that I made. And when I make the trades, I send an alert out to members. Even more important than that, to me, is the actual learning you're going to do in here. So it's not just an alert service where I just throw out my trades. Really, the meat of the service, what I consider most important, is the daily video. So you hear me talking, the type of stuff we're talking about in this webinar here, on a deeper level. And there goes this malware that I've got popped up here. I don't know what that is, but thanks, guys, for the tips on getting rid of this. But anyway, going back to here, there's a 5 to 10 minute video every trading day that sets up what we're looking to trade, our overall analysis, the sectors that are in play. Then you've got my focus list here. We analyze our current trades. There's a little summary, but you want to listen to this video every day. What a lot of people have told me is sometimes in the beginning, especially if you're a beginner, it can be a little overwhelming, but after about a month or 2 months of listening to me every day, it's like osmosis, and it just hits them at one point, and they start to really understand everything. And at that point, you go from just listening to my alerts or trading off the alerts to understanding what's going on and going over the focus list and making your trades off these focus lists. So, okay, last questions here. Okay, we've got tickers here, VVUS. Not really much going on here. I do like that it's heavily shorted, 19. But there's nothing to do right now, but what I would do is I would put it on my list of high, and it's also a dollar stock, so we're getting into the type of stocks I don't want to trade. But I do like that it's heavily shorted. And then AQNX, nice trending. Got some short interest here. So this one could be setting up. Sorry, that's the wrong ticker. AQNX. And for some reason it's not pulling up on Telechart here. All right. What exactly does short interest tell you? So basically, when you short a stock, you're selling when you buy and you're buying when you exit. So when you exit, you're actually creating demand. So you want to find heavily shorted stocks. You want to find heavily shorted stocks that have potential for a short squeeze, because what happens is shorts tend to be nervous Nellies, and they all get out at about the same time very quickly. And when they all get out at the same time, they're actually creating demand for the stock, and you get these short squeezes that are bound to fail at some point because they're only moving because of the short squeeze. So that's what this is telling you. The short interest ratio is actually taking the number of shares shorted and then dividing it by some kind of volume. So I don't know how exactly the calculation is. Or you can use the pure short interest, where it just tells you the amount of float that is actually being shorted. Okay, are these setups with short interest and low float and catalyst also setups we can use for different trades than biotech? Definitely. So if you've heard me talk about earnings breakouts, low floats, a lot of the other stuff we trade, I focus on short interest and low float, but a lot of these tend to be biotechs. But yeah, you can do that in any sector. All right, ENDP. Now this one has been on my radar for a while. It had great earnings. And we can see here now overall, longer term doesn't look so good, but more recently, you can see we had an earnings breakout, and somewhere, this is my earnings breakouts list, I've got about 100 stocks here from various different sectors that broke out from earnings this past quarter, and I know ENDP is in here somewhere. Fantastic breakout, high type flag. Those of you who know my earnings breakout setup know one of the setups we trade is the high type flag. I like the way it's holding the 9. You could take a shot here, again use a loose stop, or just wait for the breakout of the high here. So I like ENDP a lot. INSY, not much going on here, but this would be on my highly shorted list at 18 there. So fantastic number there. So put that on that list, but not really a trade yet. You guys are giving me a lot of tickers here. I'll go through a few more. BRX tends to trade with a mind of its own. I day trade this stock like crazy, but I don't swing trade this one. INSY, oh, we already talked about that one. HTBX. Like the setup here, biotech, 13 very low floats. This could be junk type stock. Yeah, this is the classic junk stock here. Low float, very volatile, dollar stock. It was trading with hardly any volume. Some news must have come in here to push it up. I like the overall pattern. I would say be very careful. And if you are going to trade, risk very little on this trade and just make a speculative type trade if it's a swing. For day trading, you don't have to worry quite as much about that. SCYX, another low junk type low floater here. Very volatile, $3 stock. One that I would be very careful was a nothing stock before. All of a sudden has some interest in here. I like the overall pattern and setup, and it could move, but again, be very careful with that type of trade. Okay, let's do one more ticker here. M. Where'd it go? MRNA. Gap down, low floater. You guys know your junk stocks here. That's good. That's good if this is the style you're trading, but be careful when you're trading this. I don't see much of a setup here at this point with mRNS, other than there's some volume coming into it. Okay, guys, so this was a great webinar. I enjoyed it. Remember, guys, you can sign up for the Swing Trade Report. There will be a class coming soon. And go to Bulls on Wall Street. I've got a ton of free content. You can also follow me on my Twitter here, and I've got the stats pinned here, and I've always got different things that we're doing in the report that I'll talk about in here. So find me on Twitter, Bulls on Wall Street. You guys know my personal website. A lot of free content on the blog on Bulls on Wall Street. A lot of educational stuff. So you can check that out. And I think I'm going to do another webinar pretty soon here. So we'll shoot for one in September here at some time. So all right, guys, I will see you guys next time. And don't be afraid. Also, don't be afraid to email me, singjd1@aol.com. Talk to you guys later.